What happens when the Fed's most powerful tool becomes its biggest risk? Let's take a closer look at something quietly shaking the world of central banking. It could change how interest rates are set, how banks manage money, and even how the United States government borrows. This tool is called interest on reserves, or IOR. And now, some people are talking about removing it completely. To understand why that matters, let's start with a simple story. Think of a big water tank that helps supply a city. It keeps things running smoothly during high demand. That's what reserves do for banks. And just like the city pays to keep that tank filled, the Fed pays banks interest to keep their reserves parked safely. That's what we call interest on reserves. But now people are asking, do we still need to pay this interest? This debate is gaining attention. Big names like Senator Ted Cruz and economist Jeremy Siegel believe that removing IOR could save trillions and help reduce the United States deficit. But there's a lot more to this than meets the eye. And that's exactly what this video will help you understand. We'll break down how this one tool became the heart of United States monetary policy after 2008. We'll look at what could go wrong if it's removed, not just for banks, but for the bond markets, for liquidity, and even for the United States government's borrowing. You'll also see how this change might ripple through the financial world in ways most people haven't even considered, from short-term lending rates to corporate cash flows, from treasury auctions to market volatility. This isn't just policy talk, it's about understanding what really moves our economy. So, stay with me, because by the end of this video, you'll be ahead of the curve with insights that go deeper than headlines and smarter than market noise. But before we go ahead, take a moment to subscribe if you haven't already. This channel brings you deep, research-backed content that goes beyond the surface. No fluff, no noise, just insights that actually make you smarter about the financial world. If you value content that connects policy, markets, and real-world impact in a way that's easy to understand but rich in detail, hit that like button and share it with someone who needs to know what's really going on. Let's go back to 2008 to see how this started. During the financial crisis, the Fed pumped trillions into the system by buying Treasury and mortgage bonds. That flooded banks with cash. To avoid chaos in interest rates, the Fed came up with a new system, a floor system. In this system, the Fed started paying banks interest to hold on to that extra cash. That became the new way to control interest rates. Here's how it works in real life. Imagine you're a bank. You have extra money. Instead of lending it to another bank and taking risks, the Fed pays you 4.4% to keep it safe with them. That's a no-brainer. It's safe, easy income. At the same time, money market funds earn 4.25% overnight through another Fed tool called the reverse repo facility. These two tools help the Fed keep short-term interest rates stable. Think of it like a thermostat keeping the room at a steady temperature. So why do some people want to remove IOR? The short answer is money. The Fed is paying a lot in interest right now, more than it's earning from the bonds it owns. So technically, it's running at a loss. People like Cruz and Siegel argue that removing IOR would save the government over $1 trillion. But here's the catch. Those savings are mostly on paper. The Fed has a rule. It must first recover past losses before sending any money back to the Treasury. So even if IOR ends, we don't suddenly get a budget boost. Now let's talk about what happens if IOR disappears. Without this tool, the Fed loses its grip on short-term interest rates. Imagine an AC without a thermostat. It'll still blow air, but you can't control the temperature. The same thing happens here. Rates become unstable. Banks would also lose a big source of income. Small and regional banks, in particular, rely on the steady 4.4% they earn from IOR. JP Morgan says removing it could cut their profits by 5 to 10%. That's a big deal. It could make banks pull back on lending. Reserves aren't just extra money, they're a safety net. They help banks manage sudden withdrawals or market stress. If the Fed stops paying interest, banks might move that money into T-bills or even riskier assets to chase higher returns. That makes the system less safe. We've seen this before. In September 2019, reserves fell too low. Overnight repo rates spiked to 10%. The Fed had to step in with emergency support. Here's another way to think about it. Imagine banks are a city and reserves are the water tank. When the Fed pays interest, banks keep the tank full. Take that incentive away and the tank runs dry. When pressure builds, like at quarter end or tax season, there's no water left to handle it. Without IOR, overnight lending markets could get messy. Rates might swing wildly, making short-term funding more expensive and uncertain. Now here's something most people miss. Just because the Fed stops paying interest to banks doesn't mean it actually saves money. It's not that simple. If the Fed stops rewarding banks for holding cash, those banks might move their money elsewhere, like money market funds. And guess what? Those money market funds then park that cash back at the Fed through something called reverse repos. And yes, the Fed pays interest on that too. So instead of paying banks, the Fed just ends up paying money market funds. The cost doesn't disappear, it just shifts from one group to another. Let's not forget the politics. Fed Chair Jerome Powell's term ends in May 2026. A new leader could push for faster balance sheet runoff, meaning the Fed stops buying new bonds when old ones mature. That means the Treasury has to find more buyers on its own to fund government borrowing. That puts more pressure on the Treasury to find new buyers for those bonds. And with large government deficits, this added bond supply could push interest rates higher across the board. That affects everyone, from home buyers to businesses. So, what's the bottom line? Removing IOR removes the Fed's anchor for controlling interest rates. Banks could lose billions in income, lending might slow down, liquidity risk could come back, like in 2019, and higher Treasury yields could make borrowing costlier for the government and for all of us. This isn't just a small technical change. It could reshape how the entire United States financial system works. If this helped you understand something new, hit like, subscribe, and share it with someone who follows the markets. Because in finance, stability is earned, not assumed. Stay curious, stay informed. See you in the next one.